Our risk in the stock market is essentially the possibility of losing our money. If we paid 100,000 to own a business or a portion of a business, then we're risking that 100,000 in hopes that we will get more than what we paid. Simply put, our odds of succeeding in this investment is 50-50. We will either get more money or lose money. If we're only looking at how much return we can potentially make, then we're only looking at one side of the coin. The other side of the coin is looking at our potential loss from that investment. That's our risk. From there, we can further analyze if our potential return is worth the risk that we might have to endure. In Monish Pabrai's words, heads I win, tails I don't lose much. So, how do I put this lesson into action? When I'm evaluating companies, I look at the company's annual reports for the good stuff. All public companies in the US are required by the Securities and Exchange Commission or SEC to file a 10K. And a 10K is a comprehensive report about the company's financials. I treat these reports like one self assessment. Who is better to know about the good stuff that you've done but you and those closest around you? So I trust that the management team of the companies that I'm interested in are painting the rosiest pictures of the company or telling the best stories in their annual reports so that they can attract investors. I calculate my potential returns based on the information that I gather from the 10Ks, but I make sure that I look at it with a fair and reasonable assumptions. Now, the other side of the coin, looking at the possibility of losing my hard earned money. This is where I turn to the news or talk to other people about the negative things that they have to say about the companies that I'm interested in. And then I sort the information to see what will affect the company negatively in the future and those that are temporary and correctable. I also look at the company's competition to see how likely they will lose their edge, if they even have any that sets them apart from their competitors. I ask questions like, what would it take for these companies to go out of business? Who can make them disappear? And do I see these companies doing better in the future? And will I be surprised if these companies are not around 10 to 20 years from now? If I cannot answer those questions and the company's future becomes too hard for me to predict, then I deem those investments too risky for me and I turn away from it no matter how high my potential return could be. Remember, do not risk what you cannot afford to lose.